Here we go. You've clicked on Three Guys in an iPad, the never-ending virtual happy hour of the mortgage industry. I'm Brian Rieger, one of the aforementioned three guys, and I'm joined today, as always, by the other two great men that have been on this show from the very beginning. Rick Grant of Content Beacon and RGA PR. How are you, sir?
Doing great, Brian. It's good to see you again, as always.
Oh, likewise. And of course, we would not be complete without Kevin Breeland of Amplify Credit Union in Austin, Texas. Kevin, you complete us. Where are you coming to us from today?
Texas Stadium.
Fantastic. I would expect nothing less. And we'll come back to that, but we've got a lot of great guests today. We've got kind of an extra fun-sized show today, and we've graduated the peanut gallery. Today, we're bringing you the Animal House. We've got three special guests coming to us. All of them are return guests, and each one of them could have his own show in his own right. So we'll start with our only three-time contestant now, Mr. Chuck Cain, EVP at WFG National Title. Chuck, coming to us from Cincinnati. How are you today?
Great, Brian. Thanks so much for having me back, and we're finally getting some summertime weather here in Cincinnati, so looking forward to it.
Yes, likewise. In Cleveland, that means rain. So, but we're thrilled to have you back, Chuck. We've also got one of our very first guests, Brian Levy, who is of counsel with Catton & Temple in Milwaukee. Brian, welcome.
Thanks, Brian. Good to be here again.
Good to have you, man. And then our final guest, of course, also one of our very first guests. He's coming to us from Princeton, New Jersey, and that's Trip Riley. He's a partner with Saul Ewing, Arnstein, and Laird. Trip, how are you today?
Fantastic. Hi, you guys. Thanks for having me back.
Glad to have you, Trip. Glad to have you. Gentlemen, I'm going to open this up now to kind of our Animal House. Who'd like to jump in and let's talk about, again, let's start with the recent announcement by the GSEs that they're now going to offer a payment deferral option where the missed payments would come at the end of the loan for the COVID forbearance folks. Who'd like to jump in on that?
Well, I'll be happy to start. I think this is a good step in the right direction, providing more insight as to how the forbearance will play out in the long run for borrowers. I think there's still a lot of unknowns, and there's a question as to whether this is going to be the best solution for everybody. Some people may want to pay it off over time or pay it in a lump sum. Probably not, but everyone's situation is unique, and this certainly gives you the option to just pick up where you left off, essentially, and pay it off at the end, which 15, 30 years later, or when you sell the house, is probably a much better option for most consumers than any other alternative. Again, there are question marks still out there around how servicers will be able to implement everything for such a large number of people.
Yeah, and I think also the issue is, what about the servicer's obligation with respect to those payments, their obligation to remit? I know that maybe the GSEs, they can deal with that, but what about other investors? Even if those other investors allow this to occur, is that going to be applied equally to the servicers, saying you don't have to remit on those missed payments, and we'll just wait to the end? And if you think about investors who are within trusts and so forth, how do you really get them to agree to that? So granted, most of these loans are GSE related loans, the bulk of that are in the United States, but there's still other investors. And so, one class of borrowers are being treated one way and another class may be treated a different way. So that's one issue. I do think, though, that the notion that was put forth in the recent announcement that a borrower, even if they are doing a deferment or a forbearance and then a deferment, can also still get a loan mod if they want to. So there's not going to be any impact on that right. And I think that's really important.
Well, as I said, I think there's other issues, and one of which I talked about in my mortgage musings recently, which is that I don't think the messaging is very clear around those people that are exercising forbearance or using it as to what the impact may be on their ability to get future financing, to refinance, to buy a new house if they decide to move. It's very unclear. I mean, the legislation said you can't negatively impact their credit, but that doesn't mean you can't report it. And I think it's going to be reported on, it already is being reported on credit reports in a notation of some sort. Kevin's nodding his head. I'm sure he's seen that with his borrowers. And so the question is, well, how will that be viewed? We know how it'll be viewed in the first month, but we don't know how that's going to be viewed 3 months, 6 months down the road. Is it going to be viewed like a default, which is pretty much foreclose? That's a bad choice of words. Prevents you from being able to get a refinance for at least 12 months? Or is it going to be viewed as something less? And does it matter what your story is as to why you used forbearance? I mean, most of the people that are going to use forbearance are in tremendous need right now because of job losses, income losses. But there are some people who, think, well, this is, just a chance for me to not have to pay something and pay it later, which is always a good thing. Well, if you can't refinance at a lower rate, or you can't buy a new house, or you can't get other credit, whether that's, auto loan or unsecured or anything else, that may, you may want to think twice about that if you have a less of a need than some other people.
I want to jump in quickly there, Brian, to follow up on that. And again, for our viewers out there, we've mentioned this in the past, but Brian's got a great blog out there called Mortgage Musings. And I believe the issue that you're referring to was the last one, right? Was that about May 10th, May 11th that came out, give or take? And you discussed this very topic. Yeah. And I did want to ask you, Brian, though, isn't it possible, I guess you mentioned the possibility, but what's the likelihood, just by the sheer numbers of folks going into forbearance, as it would seem, what's the possibility, what are the odds of that impacting how lenders view this down the road? Is it likely to kind of soften the blow if there are that many people in forbearance? At the end of the day, lenders want to make good sales, but isn't there a pretty good possibility that sheer number will kind of influence how they view it?
Yeah, I mean, look, there's something like 8 million people now in forbearance based on the NBA's numbers, and that number's increasing. We saw the unemployment numbers came out today, May 14th, and we're up to 36 million unemployed. There's going to be more people using and needing forbearance. So the question is, in the future, how is that going to be viewed by creditors? And there's a very low threshold, almost no due diligence whatsoever that a servicer needs to do to confirm that somebody needs forbearance. But that doesn't mean that at a later date that another creditor may not ask the same question. Did you really need forbearance? And that's the issue that I think some borrowers need to be aware of.
Great point.
What I've seen so far, and we've had this come up on a few customers, is that the credit report is being noted as, as in forbearance or deferred. Deferred is how they're referencing it. But in the cases that I've seen, the potential customer wasn't even delinquent. They were current on their mortgage. But because the CARES Act allows them to take advantage of this, they took advantage of it. And in all the cases I've seen so far, I didn't even have a customer who was unemployed. They were all still working. So they took advantage of the forbearance. But from a lending standpoint, it's a hard stop. I mean, they have to be reactivated, back making their schedule, their regular full monthly payments. And then it's not, it's not looked at as a negative on the credit report. It's just like, okay, you took advantage of this. When did you restart your mortgage payments? And then how have you done since you've restarted? And that's the guidance that we've received so far. And
Right.
I would imagine that while I completely agree with Brian that many people are going to need it, what I've seen so far is people who don't seem to need it, but because they can take advantage of it are.
Chuck, you wanted to jump in there.
Well, yeah, one thing which, and I'll just say this as an old criminal defense attorney, it sounds to me along the lines of, at trial, you can't bring up the defendant's previous criminal convictions, but you can certainly bring them up at sentencing. And maybe this is sort of how this all comes into play. But and I'll just throw in here too, from the standpoint of title and settlement, and it's a wrinkle, and it's probably not more than a wrinkle in the scope of what the questions that are still unanswered. But what sort of modification documents need to be executed? What sort of redisclosure needs to be done? I don't know that there's real clarity on that. But certainly lenders need to look at things like their title insurance policy as to what they are insured for in regard to their mortgage. If there's an extension, 4 months or whatever the time frame is beyond the current maturity, are they still insured? They're probably going to have to get some sort of endorsement to that policy. There's going to be an additional cost to bring these people back into the system, I think, in terms of redisclosure and documents to be signed and perhaps recorded. So it's there'll be more as the devil's in the details. But as the details come out, I think there's going to be more expense to this than a lot of people think.
Well, let's go a little further down the rabbit hole here, gentlemen, in terms of the forbearance crisis. What's the additional impact we're expecting in terms of availability of credit or lending activity overall? And how long is this impact going to last?
Well, I think we've heard from others that there's a contraction of credit, and I can tell you that based on what I'm seeing, there's definitely a contraction of credit. And I'll give you a few examples. That contraction of credit is existing in a couple of different areas. One is in your purchase 3% down Fannie Mae, Freddie Mac loans, Home Ready, those types of products. Customers with excellent credit scores aren't necessarily being approved through automated underwriting systems on those programs because there has been a credit contraction. Cash out refis. While some companies like the one I work for are still doing them, others are not. We had a period of time where pricing for FHA, VA, USDA was so out of market that no one was, we weren't doing any. It's come back a bit. But since we are a seller servicer and we also do loans on the correspondent side, we've seen our correspondents go in and out of the market on different products. So this credit contraction to me is very similar to what we saw in 2007 as far as 2007 and 8 as far as products being available, not being available. I think the difference is that more and more as the market settles into whatever this new norm may look like for the MBS and how much the Fed is going to be purchasing those securities, this contraction of credit is going to continue. And that's and in every downturn I've ever seen and ever been involved in, and I've been doing this for 41 years, that's the first thing that happens. Circle the wagons, make the loans a little harder, increase the credit requirements, and then you start easing up as things get a little bit better and a little bit stronger and a little bit stronger. So right now, we're in the circle the wagon mode. We're making things tighter. Credit requirements are going up. I have some loan programs now that where we could do 620. We're now at 680. And that's the first stage. The next stage will be a period of time where we don't see any, and then we'll start seeing a gradual lightening up of credit criteria. But we're probably 18 months, 2 years of this credit contraction back to the norm.
From a litigation and risk avoidance perspective, Seeing what Kevin has said, I'd also be concerned about underwriting guidelines with respect to minorities. Just because, if across the board the credit scores go up that are required go up, that's probably fine. But if the underwriting starts to be different in Cleveland than it is in Washington, D.C., or the suburbs of Washington, D.C., and the questions that are being asked and the inquiries that were made, and they're based, you had a forbearance. Why did you have a forbearance? What was your job? What did you lose? What's the chances of getting the job? And those are all, generically fine questions. But if they start to be twisted a little bit and basically affected by the level of income based upon the type of job you have, and then that goes into, as we know, we have a pretty active fair credit and fair housing investigations right now. I mean, investigations generally. I mean, that's even the CFPB said that's number one on their criteria is for housing. So again, I'm not saying that it's a foregone conclusion that there'll be those problems, but certainly underwriting needs to be, and the risk people at the lenders need to be thinking about that.
All right, very good. Oh, go ahead.
I was just going to add that I think Tripp's really hitting on something, and one of the things that I think is probably readily apparent is that the impact of this, the job losses and the income losses are going to be disproportionately impacting low-income people. These are hourly workers that have been displaced, and low income tend to be overrepresented by minorities. This is going to be really kind of tragic for minority lending and for people at the margins. And so we'll have to see how that all shakes out. I mean, it's pretty clearly not the lending industry's fault that these people are losing their jobs and are losing their income. But we're not allowed to lend to somebody who's lost their job. And is that a problem that we are going to be held to account for? I don't know how we could be, but it could come back.
Brian, I think you're right. Both of you and Tripp are right about that. I think that's a story that's going to get bigger as this pandemic, as the crisis goes on. That's going to certainly bear watching. Now, we've discussed at length, gentlemen, the potential of a liquidity crisis for servicing. We've talked about that at length. But I'd like to now maybe talk a little bit about some of the other potential effects of the virus on servicers. And Tripp, I'm going to ask you to start on this one. My first question there is, what are servicers telling, or what are they supposed to be telling borrowers about the impact of forbearance on the ability to get financing for 12 months? And again, Brian, we'll come back to you because this was a big part of your latest mortgage musings. But Tripp, I'm going to start with you on that one.
Well, I'm not aware that the servicers, when they're discussing with their borrowers their options of forbearance, loan modification, that they have any requirement to tell their lender, the borrowers, hey, if you do this, this is how it's specifically going to impact your ability to get financing, whether it's refi or whether it's buying a new house or it's buying a second house, a car. I don't think that number one, the typical servicer employee is been trained well enough to even do that, even if they wanted to. And quite frankly, I'm not so sure I'd want them to, because if they're wrong, or if they don't quite get the gist of what's they're supposed to be saying, and that, coupled with that, I have seen my servicing clients have been getting all kinds of written inquiries about forbearance, about refi, about the status of their loan once they're in forbearance, what's happening. And now with what the GSE's just put out, there's going to be more questions. And those servicers need to have their employees trained. If they get a qualified written request or a notice of error, but these are going to look different than your typical QWRs and error notices. So they have to be really keenly aware. And actually, I would tell them they have to treat almost every communication as such, and then follow the guidelines and regulations with respect to responding to their borrowers required when those type of notices and requests are received.
Brian, I'm going to come back to you on that too. What's in terms of what, and again, you eloquently addressed this quite a bit in your most recent blog, but what is the impact of what servicers are telling or failing to tell borrowers about forbearance? And I know we've skirted this a little bit, but I want to come back to you on that a little more.
So what we've seen is the CFPB's complaint database has seen a massive jump in complaints about mortgage lending again. And it probably relates in large part due to confusion about the options for forbearance and what that means, notwithstanding the fact that the GSEs are trying to provide some scripting for the servicers. The messaging keeps changing. Just today, we saw the FHFA come out and say that they were going to extend the foreclosure moratorium until June 30th. Now, what that means to mortgage professionals and real estate professionals is very different than what it means to the average consumer who doesn't quite understand the difference between forbearance and foreclosure. And the messaging is just very confusing for the average consumer. And frankly, the ability of a servicer or anybody else in the mortgage industry to explain this to a borrower when it's changing day to day is very difficult. I think a lot of people think that they don't have to pay their mortgages for the next 30 days or the next 60 days or whatever it is. They don't quite understand all the intricacies of modification and forbearance and foreclosure and what it all means. Unfortunately, that's what's happening.
Well, let's touch on that a little bit here, Brian. And someone earlier mentioned it as well. We're probably looking at a surge of loan mods down the road, correct? You've got a lot of folks in forbearance. Probably many of them aren't going to be prepared or even be aware that there might be a lump sum payment coming at the end of that. So I'm going to throw this out to the gallery here. What, if anything, are servicers doing right now to prepare for that surge? What should they be doing?
Well, I can tell you that, my experience and my discussions with my servicing clients they're fairly prepared for loan mods. I mean, that's what they were trained to do coming out of the 08, 07, 08, 09 time period. So they're staffed up for that. And it's not really going to change because the way they'll approach it, because their borrower is in forbearance. I mean, because that forbearance is just treated as if there's nothing wrong. I mean, so, in terms of, no one's going to say, well, you can't get a loan mod because, or you have to jump through some different hurdles because you're in forbearance. So they certainly shouldn't do that. And I think that's the whole point of some of the CARE Act's forbearance ideas. But you're still going to have to, I think they'll just treat the request for loan mod the same way they otherwise would, without regard to whether they're in forbearance or not.
Kevin, what are you seeing on this?
Well, taking into consideration what FHFA put out today about being able to put all the forbearance payments at the very end of the contract. Obviously, we have the point that Chuck brought up about, well, how do you extend the title insurance? And you're going to have to modify that to cover that additional 4, 5, 6, 7 months at the end of the contract. I really do believe that what they're probably looking at more than anything is people who take advantage of the forbearance, once they get back on track, will probably at some point in time refinance their loan. And so with that being the case, I don't know that the title insurance issue is going to be that big of an issue. Now, you take 8 million people, how many millions of those people would actually refinance their loan? I would say, and I'll throw out this number: 70% of them over a period of the next 10 years will do some refinance of some portion. So I think the net number that you're actually looking at that might carry this out to the very end is a pretty de minimis number, because the average lifespan of a house between ownership, depending on what region of the country you live in, is anywhere between 9 to 11 years. People move, their lives change, they downsize, they upsize. I mean, they do all kinds of things. So if you look at just the evolution of life, and, Brian and I can speak to this, our kids are grown. They've left. Our life has changed. And while we really love the fact that we have adult children, we also love the fact that we don't have anyone at home anymore. So it changes what our needs are from a day-to-day basis. And you have a large segment of the population that are going through this. But you also have an equally large segment of the population that's probably going to be in their home for the next 10 years because their kids are in school. So, like I said, I think at the end of the day, the number of people who will carry this out to the very end of their contract would be a very de minimis number. I think most of these people will either sell or refinance within the next 10 to 12 years.
Kevin, I'm going to jump back to something you said a little earlier, and I think Chuck had mentioned it earlier. So I'm going to throw this to Chuck and maybe Tripp, and maybe I'm misunderstanding it, so please correct me if I do. But it sounds like when the forbearances come to a close and we see some mods or whatnot, it sounds like there may be some changing in terms of title insurance or whatnot. Is there a surge of business or activity for the title industry on the back end of this, or do I misunderstand that?
Well, for the title industry, I mean, there certainly could be a significant amount of business. I mean, typically what we've seen when there's some sort of modification program is lenders tend to pick up the gauntlet and do a lot of the documentation and execution of documentation themselves, certainly with perhaps with Ron, or for that matter, just mail-aways to modification where the borrower is expected to take some documents in to get to execute in front of a local notary and then mail them back. We've seen those types of programs, but I think in regard to the insurance itself, and again, I don't think we've really looked at it. To Kevin's point, in the long run, it's probably these transactions are going to be retired before we have to deal with the entire term of that loan. But for due diligence, every loan is going to have to be looked at as the program and what are the requirements as far as sale in the secondary market, and then what sort of extension might be necessary in regard to the title insurance policy. It may only be a few dollars. It may not be a big thing, but when you put it in scope of millions of mortgages, then suddenly it does get to be a lot of dollars. It's not burdensome to the title insurance industry to do these types of transactions, but it's just something that I think it builds in overall cost as to the remedy. Maybe that's not quite the right word here, but as to into that modification circumstance. What it does as to what the lender's due diligence requirements are and what they've got to pay out, because my guess is the lender's going to get to pay this money. It could be passed through to the borrowers. Again, remains to be seen, but my guess is the lenders are going to get to pay this money. And even if it's $100 a transaction, you can do that math in your head pretty quickly about what it's going to cost.
True.
Yeah, I mean, I think Chuck is hitting on it, which is, so if I'm an underwriter and we're now 18 months down the road, am I not checking to make sure that the refi that I'm issuing a title policy on, the borrower wasn't in forbearance or was in forbearance? And how do I know for sure? Sorry, guys. How do I know for sure that when I refinance, the lender's money that's being used to refinance is paying off that back end portion, right? And so do I write a policy that accepts any potential title issues as a result of that back end not being paid off. And maybe but maybe I'm also, if I have sufficient documentation to show that the $100,000 is going to pay off that, and then the amount that's in that, the way that FHFA describes it, in escrow, in like a separate sort of accounting system, I'm going to want to know that that's covered or that's going to be paid off without before I'm going to issue a policy that doesn't have some sort of exception to it. So I think that's, and then as Chuck was saying, so what's that going to cost? Is as an underwriter, I'm not, that's a risk, and I want to get paid for covering it. So who's going to pay that? The borrower, the lender? So yeah, that's just sort of the issue for me. And then obviously, as someone who does coverage and claims work, I think there's a good chance that in a couple of years you'll start seeing those, sort of like the HELOC, failure to pay that off, but you knew it was there. And so there's sort of those claims. There won't be much, it might be $20,000, $5,000, depending on the size of the deferment, but they're still there. And so there could be some title litigations as a result of that as well.
Gentlemen, any last thoughts? I'm about to take a hard left turn here in the topics, but any last thoughts on the impact to servicers or the impact of the forbearance crisis?
I would like to just talk a little bit about, and I don't really know where it how it exactly translates, but I'm thinking about, the extension of the foreclosure moratorium, again, just issued today by FHFA. What does that do? I mean, we've actually, this has been an interesting period. We haven't seen housing values go down, despite the fact that we're dealing with this massive job loss, the economic disruption in the economy. The last time we went through this, 2008, the housing values, dipped 30% in some markets, maybe even more. So we're seeing appraisals holding up for the most part. How much of that is due to the fact that we've just shut down the foreclosure market? There's no, that's sort of the bottom range of housing values that tends to draw down the values in any market. We've shut that off. So you've only got, ready, willing, and able buyers and sellers making transactions. Just curious as to what everyone thinks about that.
Yeah, I think the fact, not only that there's not a glut of houses on the market, which would drive the price down, but you also see sellers holding on to their houses. They're not running away saying, let me sell this so that I get some money, some equity out, and then move on to a smaller house. That just isn't happening. So I think, Brian, you're absolutely right. For those two reasons, the prices are steady. Now, it may change when those 8 million people get about 6-7 months into it, or even in a year after the forbearance time is over, and they're like, I got to get out. I'm going to default, and I got to get out.
There's probably some people who are saying, I've got to get out because I can't live with my family in this house anymore.
True story.
And I'll just add real quickly too. I mean, talking about this, what the stats have shown is that buyer demand and listings have dropped in fairly comparable numbers in most markets. So where things have slowed down as far as buyer demand, well, the listings have fallen off as well, that's helped stabilize the home prices. And now we're starting to see in some areas actually a genuine surge. We're seeing April purchase transactions in Florida hitting a tremendous month in April. South Carolina is seeing no fall off in home purchasing. And so in some markets, we really haven't seen that much of a fall off. But I do agree, and it's something, say, obviously at my end, because these policies come due. But as has been discussed, where those foreclosures will hit, it's going to be in that lower dollar market, I think. It's going to be in that starter home market, that under $200,000 house. is going to be where we're going to see these foreclosures, because that's where the 19% of unemployment, if it's going to hit, it hits in that marketplace. And we will start to see it. And I can tell you that at my end, we are seeing vigorous interest by real estate investors starting to look at houses right now and starting to research where they can as far as houses and market to homeowners that they cash for your house. We're starting to see some very vigorous activity on that, particularly in the mid-Atlantic and Midwestern states. So it's going to be a very interesting market as we pull through the third and fourth quarter as to home purchases. But we're looking for some significant rebound, not resurgence perhaps, but rebound in home purchases. We're even starting to see it in areas like the New York metro. So it's an interesting phenomenon to sort of watch this as it moves forward. But yeah, those foreclosures, I think those foreclosures are going to be heavily in the bottom end, and certainly the investors, they're already, the sharks are already starting to circle on those houses.
Well, Chuck, as a PR guy, I'm listening to us talk about the impact of this on servicers, the impact upon, down the road as we take these forbearances and turn them into loan lots. But it sounds like we are looking at a default and foreclosure spike. And certainly we've had all-time lows for the past several years. But it sounds like we're going to start to see some defaults and foreclosures again. So I'm going to bring Rick Grant on here as the other PR guy. Since I asked the questions, we'll have Rick do some answering here. But, I remember back to 07, 08, 09, and some of the very large banks and servicers took a beating on the PR front for, there's nothing pretty about a foreclosure. We're having a business conversation here, but PR is a part of business. So, Rick, these servicers and these lenders, what do they need to be doing? And I'll invite the rest of the group to jump in as well. What do these guys need to be doing to avoid that PR beating on the flip side of this? And I'm not going to name any names, but a couple of the really big guys really got hammered in the mainstream media and the national news for the way they went about foreclosing, right or wrong, good or bad. So, Rick, what do these guys need to be thinking about right now for when that time comes?
Well, let me just start by saying, Brian, I don't think it is likely to be anywhere near as serious as the last crisis that we saw as far as foreclosures. First of all, back then we had been doing subprime lending heavily for years. We had a ton of people at risk in homes. And we don't see that now. In fact, just before COVID, we had the lowest foreclosures that we'd seen since pre-crash, and it was way down. Second thing is, I think this may be a PR stunt all in all, this whole foreclosure moratorium, only because the people who are in foreclosure today were in that path before COVID hit. We all know about foreclosure timelines. It takes a while to get into that. These people were already in trouble before this hit. So not pushing them on through the system doesn't make a whole lot of sense to me. But from a PR standpoint, sure, it makes everybody look good, right? Because we're being good to people. It's all about timing in my mind. If we are not at work for another 3 to 6 months, then we're on the edge of a real problem. If we are out of work longer than that, then I agree with Chuck. We're going to see the low end drop out because they are not going to be able to catch up. They're going to burn up all the equity that they have, if they have any, and they're going to be underwater again. And that's going to lead to all kinds of problems. What can servicers do to stop that now? Well, first of all, servicers, and we've already discussed this, are in a real serious problem right now because they don't know what to tell borrowers, and anything they tell borrowers, frankly, is going to be misunderstood. The good news for the industry is when they refinance or when they sell or buy a new home, all they do is they contact a lender and they say, give me a payoff number. They don't ask, how much of that payoff number is my escrow for the forbearance? They don't care. They don't understand any of that. I don't think most people understand the way the interest is handled, right? So amortization, they just don't get that, right? So does it matter? No, it's not going to matter in the long term. They need to do what they're doing, try to stay in touch. Most of the big servicers that I've heard from or heard from someone else that knows them, they're handling most of this in an automated fashion anyway. They're trying not even to talk to borrowers. They're just throwing up websites and say, here, click on this if you want to go into forbearance and fill this out and whatever. So they're keeping a distance. The best thing they can do is pay attention to the guidelines, work with their compliance attorneys, find out exactly what the right verbiage is, and then make that available everywhere as early in the process as they can.
Other thoughts, guys, on the potential for any kind of PR missteps? And Rick, I'd agree with you. I don't think we're looking at the same kind of default crisis we had last time by any means. But any other thoughts there, guys, in terms of branding and whatnot?
I think that the servicers need to do, as Rick said, to maintain the guidelines on forbearance and, more importantly, on loan modifications, because that's, borrowers understand that the loan modification is out there. And so they just need to make sure that their communications about the loan modification are consistent and are meeting the regulations, and that when the applications are complete, they do what they're supposed to do. They treat the borrowers all the same relative to the regs. And then if they aren't entitled to a loan modification, or they don't do what's necessary to get the application completed, or they default again, even though they've got a loan modification, then they foreclose. And I don't think that in terms of a public relations issue, it's anywhere near what you had in 2008 and 2009, because the foreclosure was driven by the type of loans that were being offered and who they were being offered to, and whether it's neg AM or 120% equity, what have you. Now that's not an issue. So again, though, I think that as I mentioned before, fairness across the board is going to be really, really important, because you don't want to come back and have an investigation that says you treated the guys in Cleveland different than you treated the guys, in the Northern Virginia suburbs or Westchester, New York.
Well, okay, that sounds like it sounds to me then like we're in pretty good shape. But I'll remind our viewers, it's never a bad time to check with your compliance consultants at a time like this and shore up your policies. Never a bad time at all. So let me move on and take that hard left turn I talked about. And of course, we've talked about some pretty serious things. This is relatively serious. This is more of a business issue, but this is about the time when we all usually, in a typical non-pandemic year, start to scramble for a hotel within 10 miles of the MBA annual or the Alta annual conference. And it's going to be a very different fall, even if everything improves dramatically. But I want to throw this out to hear from a lot of you guys in this one. What kind of impact is the virus going to have on the fall conferences and conventions? I know, this group, we get together quite a bit at the fall shows. It's a chance to kind of see your friends, catch up on things, have dinner, or get some content and whatnot. So do you think it's too soon to even be talking about that? Do you think people are going? Should these conferences be happening in the first place, or should people be pushing them out?
Well, I'll just jump in because, my company has a conference currently scheduled for mid-September. But what we are hearing from speakers, the paid speaker circuit that does all these presentations, that they are being told, and they are seeing contract cancellations through the end of November. I would be very surprised if we see large gatherings. I think it's going to be the idea of MBA annual being at the Hyatt Regency down on the river in Chicago. Alta 1 is scheduled for the Hilton Midtown in Manhattan. I don't think people are going to rush to New York this year, no matter what anybody says. No. And so I think that everything through the balance of the year that's of any significant size is in jeopardy. And a friend to us all, Arthur Sterbko, Mark Sterbko's dad, was speaking to the president of the New Orleans Visitors and Convention Bureau. And of course, New Orleans was hit pretty hard, but New Orleans now things are settling down in terms of COVID cases. But that convention president said, we do not anticipate seeing significant conventions in New Orleans, which is, of course, is a major destination for conventions, before 2022.
Wow.
So I think that, for some time, in part just trepidation. And we see an awful lot of these conventions going to virtual. Respro is doing a virtual convention here in the third week of June. And so they're doing their speakers. We'll see how those virtual conventions work through, but I would just really be surprised if we see especially the large conventions happen yet this autumn. And there's just an awful lot of tea leaves right now that they probably will move to some sort of virtual circumstance.
2022. Wow.
I'd like to offer this perspective as well. I mean, I no longer attend a lot of these conferences any longer, but I will tell you that for myself personally, I'm a person over the age of 60. I have underlying health issues, heart issue, diabetes, things of that nature. I find going to the grocery store right now a hair-raising event. It is one that honestly, I take an enormous amount of precautions just to go to the grocery store. So in early March, we had an event that we were going to attend here in Austin, and I didn't go. And that was with the COVID-19 just kind of coming out in the news. But I thought, this is a gathering of 200 people. This seems like an unnecessary risk. And I believe that I would like to think, with the exception of everyone under the age of 30, would look at these events and go, I still have kids in school. The last thing I need to do is to be off work for 2 months because I got sick. And I just don't think they're going to have those kind of gatherings. Will they take place? I have no idea, but I can tell you that everybody who's in my situation should not go because you're just asking for trouble.
I think that, all of those points and the rationale that they espouse are absolutely true. But I think that what we haven't heard, what we're not talking about is who is going to have the money to sponsor these programs, these conferences. Look online at all the major law firms and what they're doing. And those are the major sponsors. Not always, right? Not always, but MBA, right? And Alta One. Granted, some of the underwriters at Alta One pay a large sponsorship, but right now the mindset of law firms are reserve your capital because we don't know what's going to happen next month, the month after, 6 months from now, a year from now. So all expenses are being cut. And why? Not because there's not money coming in the door. We're all still operating. We're still, generating revenue, but we don't know what the future is going to hold in terms of a downturn or when the work might dry up. So sponsorship from some major law firms that spend $25,000, $40,000 at MBA or anywhere else isn't going to happen. It's just not. And by the way, some of those firms spend that money so that they're in the top echelon, right? And so the people who go to those see them paying that kind of money. They figure they're the top echelon law firms or compliance people. And when those firms see that everyone else isn't going to pay, they're not going to pay either because it's not going to do them any good. And remember, again, not to harp on MBA, but if you think about, a 900 person conference, 65% of those people are outside counsel. And so if those law firms aren't there, they can continue on, but I don't know, it'll be just, they'll have speakers maybe, and then the compliance people, but the large crowds won't be there for all the reasons everyone said. But I also think because they're just not going to be sponsoring and not going to be paying for it.
And just to add to that, exactly, Tripp, and the vendors, so many of these shows, to my mind, a good show, a third of it is content, a third of it is networking, and then a third of it is vendors. And when you're talking about a show like MBA, and again, not to pick on them, but Alta One's the same thing. NAR is a huge vendor hall, with hundreds of vendors. Well, why am I going to spend $15,000 to pay for space and pay for the cost of shipping my booth and my tchotchkes, and I have personnel there, and spend all this cash, and so suddenly I'm out $30,000, and 15% of the people who are usually there are there. We're seeing vendors pull in their horns, especially vendors who are in the tech area, because they don't see the value in it, and the tech vendors in particular, they are especially concerned about where the remainder of this year goes. Because right now, in terms of technology, while there's still business going on, title agents, just to pick one particular group, and I'm sure this is the same in lending. Kevin can address it, or what Brian and Tripp are saying. But is this the time to change softwares? You're trying to fix a tire on a car that's moving. And so are we going to spend that money to change a software where we've been talking about it or thinking about it perhaps for months? That may get forestalled. That may get pushed off because, well, first of all, we're busy as hell. And secondly, we don't know if we're going to have the money to do this.
No.
And how do we train people? How are we going to do that? Is it all going to be remote training to be able to see a new software? So the tech vendors are especially concerned about the remainder of this year as far as retaining their capital, as Tripp is saying, in regard to just having money on hand, but also, is this effective? And is it going to be effective? And a lot of them are saying it's just not, because just because we build it does not mean they will come.
Chuck, I'm going to put you on the spot on that one there, and then we'll come back. Brian, I know you want to say something too, so I'll come back to you here. So, but I want to put you on the spot. Let's assume that the conferences don't happen, whether it be because of safety or they just don't have demand at this time or whatnot. We're starting to see, you mentioned Respro. I think Housing Wire is doing a virtual conference. A few folks are doing virtual conferences. Is it worth it? It's really not the same. Let's admit, most of us go to conferences to, as Chuck, as you like to say, see and be seen, right? The tech vendors, there's something different about throwing an online demo up there, which they do very well, versus showing it in person, seeing the body language and whatnot. So let me ask you, is it worth it to even do the virtual conferences? Is there a value there, or is it just as good? What are your thoughts on the virtual conferences?
Well, I think there's value to it in terms of content. And I mean, that's what it boils down to, because in conversations with people who are doing some conferences, it's like, well, how do we do the social thing? Well, we'll do a Zoom happy hour, and we'll set up chat rooms, and people can wander out of chat rooms. Again, Kevin and I are the same generation, and stuff like that. It's just like, that makes my head hurt to think about it. And how do I know who the hell is going to be in that chat room? And then how do I get out of a chat room if it's a useless conversation? So, but I think that from the standpoint of the content, and especially if you're talking about CE and CLE hours, and again, an awful lot of these requirements have been extended. As far as CE and CLE hours for different professions, where you may have had dates of June 30 or December 31 of this year to accomplish things. Now it's being pushed off. An awful lot of those CE, though, and CLE that I've seen, it's like, yeah, we're pushing off the requirement, but by the way, we expect you to have another year's worth of requirements met. Mm-hmm. So you're still going to have hours. It's just that we're going to give you some time to get them. And I think there's still a lot of value with that, and I think there's still a lot of value in content. And I think that's where the virtual conference works. I think how one structures virtual contents will be interesting, and we'll see how that moves forward. Do you do a day and a half of just steady content? Do you break it into chunks? And we'll see how the marketplace shakes out on this. But we're going to be at something of a crossroads. I think people will welcome meetings whenever we can all feel good about going to meetings, when there's a vaccine and there's a diagnostic test. But again, I think we're talking about, the next presidential administration before we have any or all of that. And so I think that there will be a desire to get back to it. It's going to be a while, and it's not going to be what it was. It's going to be a while before people can see, as far as sponsorship and vendor sponsorship, are people showing up for these things? So we're looking at a year or two out, I think, before we see how it shakes out. But I think there is value, certainly, on the online conferences, and especially if you've got significant speakers. I mean, again, we're talking about MBA. Well, the kind of speakers they have speak at MBA, if you're going to have high-level speakers come in from governmental positions or industry positions, there's a lot of value in regard to those speakers. But if it's going to be, breakouts are challenging technologically, but I think there's still certainly value in them. And I think that also, just for the trade associations to maintain some collegiality and cohesiveness, I think there's a value to it there as well, for the members, that you still feel like you're part of something, and that you did attend these things. And maybe you don't have the T-shirt that says you went to the MBA conference in 2020, but you went to the MBA conference at home in 2020. So I think there's still value in it, but I think that value becomes hyper-focused on the content.
Brian, go ahead.
Yeah, if I can just jump in. Let me just say, on a personal level, for me, the conferences are really valuable in person. So much of what I do is based on relationships, and those personal interactions cannot be replaced. As much as I enjoy talking to you guys on the screen, it's just not as much. It's not as much fun. It's not as personally, emotionally rewarding. And the depth of the relationship is not as easy to connect with a human being over a computer. With that said, I agree with what Chuck's saying, that there it can be value in the online conferences, but unfortunately, I think using the content that you developed in 6 months ago and try and putting it on today, it just doesn't resonate at all. And to try and charge a significant amount for content that just isn't as relevant today, I think is troubling. Updated content, COVID reaction content, the leaders of government and what they're doing, those kinds of people I want to hear from. They're at the cutting edge. What's going on in the servicing industry? What's going on in the trenches? And there's this really, you sort of talked about it, but there's this interesting conundrum for industry players. Do I figure out how to deal with some of the new things that are happening with new technology and new procedures, or do I just keep trying to do what I was doing with work from home and try and push as many transactions through the pipeline as I possibly can, using my old sort of methodologies, throwing a few new things on it, like remote notarization or electronic notes or something like that. I think it's a challenge for the industry right now. I think if you're going to do a conference, talking about those kinds of issues is what's much more relevant, but do people even have the time to really sit through it and evaluate alternatives and then implement new changes. I think that's really challenging in a time when you're just very busy with transactions. And one more thing, if I can add, it's just like I remember in 2003 when I was in-house and we were refinancing people multiple times in the same year. The business was just walking in the door. There was nothing that you needed to do from a marketing perspective as a lender because business was just, coming in faster than you could service it. As a lawyer who's involved in coming up with new ways of marketing, new ways of finding relationships, compensation, all the things that you try and do to essentially drive more business in the door. In 2003, I was tapping my pencil on my desk waiting for work. And it's a little bit the same today. There's not as much work for what I typically do. And it's because my clients are mostly just, blocking and tackling, trying to get their deals closed. And I think that creates a problem for, an online conference that isn't addressing the needs of the day.
And Brian, let's not forget too, there's a lot of uncertainty out there. I'm not sure how much spending on anything is going on right now unless it's absolutely in front of your face, so I can certainly sympathize with that. Other thoughts on the conferences before we go back to the 30,000-foot overview again?
I'll just say this one thing, Brian.
Sure.
Chuck, go ahead.
Well, I'll just say real quickly, and just to follow on Brian's comment there about the freshness of the content, and certainly this tremendous podcast that you guys put together, it's very fresh, and so people are going to see what's going on now. And when he had Sean Graham on the last one, and he talks about in terms of marketing and in regard to the content of a conference, it's the same. You're competing for people's time. And so, as I said on that one, and I still say, whatever it is you're doing, whether you're in the title industry or the lending industry or you're a law firm, what you're competing with is somebody who wants to watch a cat playing the piano. And so you have to have that kind of content that really does drive interest, so people want to see it and feel like it's necessary, something that I need.
A cat trip. Sorry, Chuck.
That's okay. Well, in my case, it is a cat playing the piano. So,
Well, I don't know if you guys know, I used to be a conference planner for Source Media back in the day in New York, and I planned some of the bigger BNC conferences back before the crash. And any conference planner who's thinking about putting together an event, online or off, and thinking the way we used to think is going to totally miss the boat. Mm-hmm. It's not going to come back. Even a year after we have a vaccine, when we have the vaccine and we have the data that says that it actually works pretty well, so people who are older and successful and that vendors want to meet, and that's why they go to these shows and sponsor them. I work with a lot of tech vendors. First thing they say is, how many meetings can we schedule? And if they don't schedule enough meetings, it doesn't even make sense to get a booth on the floor. and it doesn't make sense to schedule meetings with young executives who don't have purchasing power, right? So it's never going to snap back to exactly the way it was. We need to be thinking about new ways to engage people and let them have experiences. And Brian, you hit it on the head. We don't feel a connection. And even though we're all in business, we need that personal connection. And that's why those conferences are so successful. So it's an exciting time to be a planner. I'm looking forward to seeing what they do next.
Well, I'm going to jump on with Rick there too. I've planned a conference or a webinar myself, and it's a sausage-making process to begin with in the best of times. So I don't envy the folks tasked with trying to come up with something fresh and compelling. Compelling is just as important. I like to tell the editors at the trade pub I worked for that your content is what they should be reading. Ours is what they'll pay to come see. And it's a little bit of what do they want, and a little bit of what do they need to hear. So I don't envy the folks trying to answer these questions. We also know there are massive and unforgiving contract provisions into these large conference factories that we have out in Orlando and New Orleans and whatnot. So it's not an easy time to plan anything right now. Our thoughts go out to you. So I do want to go back for one more question at the 30,000 foot overview, and it's going to be a little bit open-ended. Let's kind of go around the horn here a little bit, but I'm going to come back to COVID, because what else would we talk about in this day and age, right? So I'm going to ask each, what's the one biggest change that permanently, or not permanently, but at least for the long term, comes about in the mortgage industry or title or settlement or whatever? What's the one biggest change that comes about directly because of the COVID crisis?
Well, I'll start that. And I'll just address this more on a personal level than what I think an overall view is. The one thing that I have seen and witnessed is our credit union, for various reasons, went to a very remote working position. Even though we were essential business, we took all of our branches that didn't have drive-throughs and closed them. We reassigned people into the mortgage department because that's where we were the busiest. We actually closed down a complete line of business and just kind of and put people remotely, had them work from home. So there's very, very few people that are actually going into our locations on a daily basis right now. What I've noticed is our overall productivity has increased. Our processing times are and I mean, when I say busy, we're $1 billion credit union. I mean, we're not a big boy by any means of the imagination, but we are as busy as you could hope to be. And while we've had some challenges because of this, because of COVID-19 and all of that, and we've readjusted our annual earnings and all of those types of things, what we have discovered is that our people can work remotely, they can work effectively remotely, and that all this office space we're carrying may not be totally necessary anymore. And I remember Arthur Sturpko talking about this after Katrina, that they went to smaller space because they were trying to get their agents back up and running, and they discovered that once the agents had Wi-Fi, they weren't even coming to the office. So they started downsizing their offices after Katrina because they didn't need 30,000 square feet anymore. They needed 3. And that's what I think from a local level will be the biggest change, is that I think companies are going to trust their employees to be remote, be effective remote, be productive remote, and meet all the deadlines and exceed deadlines.
I'd agree with that, Kevin. Trip Riley, what in your mind sticks after the COVID crisis?
Well, I'm going to take a contrarian view because that's who I am. And I really think that not to discount what Kevin said or anyone said, and not to necessarily, age certainly drives a lot of your thinking, and I appreciate that. I'm sort of like in the middle, right? So, but we see people get sick that are in their 50s too. And so I appreciate all of that. And it's concerning to me, but I can also tell you, anecdotally, I want to get out there. I'm not, and the way I run my business, I have to be, just like with Brian, I have to be in personal contact with people. Moreover, I'm a litigator. I mean, yeah, I do some regulatory stuff, but down, mostly I litigate and I try cases. And, there's a whole kind of discussion about, well, will you do motions virtually, through Zoom? And I've done them now, but it's just a different feel. And you can't really gauge the judge. You can't gauge your adversary. You certainly aren't going to be able to gauge a jury. So I don't think that, I think we'll have that discussion, right? And there'll be some modifications, but I think that as you get 2, 3, 4 years in, it's all going to come back to pretty much the way it was. There'll be people working from home. There'll be Zoom meetings and so forth like that, but they're going to get back. And I can tell you, and Brian, you probably as well, having kids that are in their teens and 20s, they're used to this, right? But they don't like this. They don't want this, right? They don't mind texting. They don't mind Snapchatting, looking at TikTok, all that stuff. But you look at Wisconsin. When they opened up the other night, those bars were full. And who were they full with? Yeah, a few older people our age, but they were young kids in there. And that's the way it's going to be. They are social. We are all social animals. Whether it's just work, which, as I just described to you, I have to do that way. So there'll be changes, no doubt about it. But to say that there's going to be some sort of revolution in any industry, other than doing remote closings because people are busy, right? And so now they know they can do them. They can do them from their home, and they don't have to go to a lawyer's office or an escrow's office. That I can see happening, okay, as long as there's no issues with the closing, the things that have to be resolved. So that could be, but I don't know if that's revolutionary because it was happening slowly but surely. But I don't think there's going to be this like conferences they'll do it now because they have to. But you can't run an MBA and an NLR where they get most of their money through these conferences, a lot through their conference. Yeah, they have membership dues and so forth, but they make a lot of money on these conferences. They're going to get back to them. It's because it's all personal. It's all social. That's the way you do business. That's the way that's the way America does business. It's the way the world does business. So yeah, it'll be slow, but I believe, nothing revolutionary is going to come out of this.
And Trip, before I go to Brian Levy on this, I'll tell you, you remind me of what's become one of my new pet peeves during the coronavirus, the new normal. Right up there with in these challenging times. I'll be blogging about that shortly. So, Brian, what sticks after this?
I fear I may be stealing Chuck's thunder here. I'm just guessing, but I actually think that the remote notarization, the remote closing thing is a revolution. I mean, it was available in some states. The technology's been around forever. I shouldn't say forever, but I mean, the industry has been so slow to adopt what is just the most obvious kinds of modern kinds of conveniences. Real estate law is just, it's premised in the 1800s. They haven't even gotten to the 1900s yet. And this has just, made us move forward in leaps and bounds in virtually every state, which, states were dragging their feet. Recorders' offices were just being, bureaucratic or whatever they were being. And I think, this is a bit of a revolution, at least at the, at the levels of real estate law and recording and, getting things done. And, I've never understood why, mortgage documents were delivered in paper. I mean, for years, we've had the ability to deliver documents electronically, and why weren't we doing it? It just seems like, you could sort through it in an instant. You have artificial intelligence, but this is all going to need to now be part of that future efficiency that mortgage companies are going to need to look to technology. They're going to need to look to new processes, and they don't have the time right now to implement all of those things. But I think there's going to be a lot of future efficiencies that come out of being able to fully digitize a mortgage transaction.
E-recording is like the printing press. Why didn't we have the printing press sooner? Because the monks wanted to make sure they were the only ones who could read, right? And with the e-recording, no one wants to do e-recording because think how many people in the recorder's office and the clerk's office are going to get laid off because they're not needed anymore.
Right.
That I would agree. There's some revolutionary ideas there or effects, but
Trip, I think there's a soundbite in there somewhere. I'm not sure, but I think I hear a soundbite in there. Rick Grant, what sticks?
So I think from a communications perspective, for years now, millennials have been telling corporations that they need to be socially conscious. They need to care about the environment. They need to care about people. And most industries, especially big industries that create products and assets that don't really have anything to do with borrowers or people except treat them as work inputs, have kind of paid lip service to that, but not so much. During this crisis, we've seen literally every corporate communicator become the consumer's best friend and beloved ally. Now, obviously, they've gone way over the top. It's saccharine crap, and most of it's no good. But what the best of them are finding out is that, wow, it actually does kind of help us build stronger relationships with consumers. I think when this is all done, the best companies will continue to do that. They'll continue to craft messages that actually take their target markets into consideration, and they'll be much better at what they do.
Another blow for authenticity. Anyone else? What sticks? Kevin, Chuck?
Well, I'll say, and going last has made it easy because I can just steal from everybody else. Now, to my mind, the singular greatest event of this age of COVID is the fact the world got to hear the sound of a toilet flushing during a U.S. Supreme Court argument. So I think that is probably the event of the year that will resonate in my mind, and probably in years to come be watched more often on YouTube than anything else. But I'll just pick up Kevin. From our standpoint in our industry, we have seen improved efficiencies, in part because necessity is the mother of invention, and what a mother it can be. And we have seen people working remotely with new processes far more efficiently. And I think that those things that were in need of better mechanization, I think they have been better mechanized. Will these changes come fast? I don't know, but they're coming faster. And we've seen the ability to do these things. And, and to, Brian's point about, the real estate industry, the title and settlement industry, and for that matter, real estate law. I mean, because I've argued cases, especially in Kentucky, one of the states in which I'm admitted. I've been in real estate or real property litigation in Kentucky where nobody has quoted a case that was not a 19th century case. And so our industry has its feet firmly planted, or has had its feet firmly planted in the 19th century. Many will say the 16th century. But what I have seen is where we had resistance to technological movement forward for remote online notary, for RIN, for whatever else that may be coming forward, that resistance has shifted to reticence. And that's a big mind change, where people were simply standing up and saying, by God, we're never going to have this in our state. We'll eat babies first. This is horrible. And it's going to, send the country into Romanism and rebellion. That's done. That's over. And I think that is a sea change as far as things moving forward. To Rick's point about PR, what we're seeing in sales, and of course we're on a B2B basis in agency, the Zoom call is here to stay. It is a highly focused way to have a conversation, a one-on-one conversation with someone where you don't have to drive 50 miles to go and see them. And it's a much more efficient way to do it. It's much more effective. But to Tripp's point on about humanizing all of it, yeah, do people want to get back to conventions? You bet they do. And for that matter, the six of us all met or certainly developed our relationships through conventions. That's where we all came together. And we've come together at conventions year after year, never going to our respective home cities, but seeing each other in 30 states across the country. So I think, there's a number of things to take away. But yeah, in my industry, though, and say to echo Brian's comment, I think that from the standpoint of how we settle and close transactions in the title and settlement industry, we're over the hump now. We're not going to have this dug-in feet kind of resistance to technological change, though it will be challenging from the standpoint, as Tripp said, these people who work in these county offices around the country, they're precinct workers, and they are nephews and cousins of people who are politicos, and there is resistance at the county level, and a lot of it is because of that. How am I going to keep my nitwit son-in-law employed if I can't get him a job here for the county? And there is going to be pushback on that on a political level, but the train's leaving the station as far as how we're going to do transactions moving forward. And our industry, our title industry, I think has reacted surprisingly, in a surprisingly resilient fashion. Drive-through closings. As I've said, who would believe that sonic drive-in would be the business process we've modeled on? Where people show up and they text that I'm out in the parking lot, can I come in now? Or you come out to me and I'll hang out through the window. And it's the industry has, the title and settlement industry has shown capability of modernization that it has resisted since I've been in the industry, going back to the Carter administration.
Well, I just want to end that if I can't have a drink with you at 3:30 in the morning at some dive bar, I'm not so sure I can trust you.
That's where I'm jumping in, Tripp, because you've just anticipated our lightning round question. Gentlemen, we're going to close on this, and I think I know Tripp's answer, but we'll start with you. Virtual happy hour. I'm game or really lame? Tripp, go.
It's not really lame, but it doesn't get me going. And so I would say that if I had to pick, I'll pick lame.
Brian Levy, virtual happy hour, game or lame?
I'm game. As the black sheep of this podcast without a beard, including Rich Horn, who all you guys. Well, I mean,
it's not too
I
late,
think
Brian.
all of you can. I think all of you can agree that for this lightning round, we can pitch in and buy Tripp a razor blade.
Never. Join us on the dark side. Chuck Cain, virtual happy hour, game or lame?
Depends on the happy hour. I've been to some that are very game, including with people here in this group. I've been to some that are just like, we can't wait for the clock to run out. I hope you only bought the free Zoom program, so 40 minutes will run out and it'll just stop. So I think it depends on how it's structured, and especially they've been very helpful, I think, when people were in the immediate lockdown, to actually see some people they hadn't seen for a while, and especially those of us who are conference junkies and used to seeing each other in different cities every month, at least to touch base. But I think it depends on the particular happy hour, because I've been to both.
Rick Grant.
Chuck, we're not looking for a serious answer. Just answer the question.
You're asking a lawyer for a short answer.
Are you in or not?
All right, you've defaulted your time, counsel. Rick Grant, lame or game?
I'm game. I'll show up. It's I've already been to a few of them. It's not the same as getting together, but it's got me shopping for whiskey again, so it's fine.
Kevin Breeland, virtual happy hour.
I'm game. I've done one. It was but I did learn from that one that I could actually take my laptop outside, have my whiskey and my cigar, and no one cares.
Well.
Hey,
Brian, yes.
Rick, if it took Zoom to get you to buy whiskey again, that's a problem.
I know I don't drink enough. I've been working on it.
There's
I'm in a
another
program.
soundbite there. On
I'm in the
that
program.
note, in the eyes of this reporter, shoot me now. Gentlemen, I want to thank you for being with us today. I'd like to thank our special guests, Chuck Cain of WFG National Title. Chuck, if they want to invite you to happy hour, where do they go?
C. Cain at WFGNationalTitle.com is that's my handle.
Outstanding. And Mr. Brian Levy of Catton and Temple, how can we invite you to the virtual happy hour?
B. Levy at catandtemple.com, or you can sign up at www.mortgagemusings.com.
And guys, check out that blog. We're going to get you a link. I'm going to get as many people reading it. It's an excellent blog. Just enough compliance to keep you legal and just enough other stuff to keep it interesting. So, Brian, if I can get everyone out there looking at it, let's do that. Trip Riley of Saul Ewing, Arnstein, and Lair, where can people reach you?
A couple places at francis.riley@saul.com, or on most other devices and places, it's NJ, capital NJ, Trip. So that's on Twitter, LinkedIn, and Instagram.
And of course, we'll have all of that in the show notes. Gentlemen, always a pleasure. I hope you'll come back and play with us again sometime. As always, to my friends Kevin Breeland and Rick Grant, thank you for joining us. And this has been an extra special and an extra long show, and I'm not sure the iPad is going to make it. It's starting to smoke. So, Rick, please take us home.
Wow, what a show. Thank you for staying with us till the end. You can't be in a room with guys as smart as those, even a virtual room, and not get smarter yourself. Really loved spending time with those guys, and we hope to do it again. Now, that was a long show, so I'm not going to keep you long now. Instead of giving you something to think about, I'd like you to give us something to think about. What do you think the real, valuable business conference of the future is going to look like? What would you attend? Let us know. We'd love to hear from you. And until next time, thanks for joining us.